You have been lied to, not with malice perhaps, but with a totality so complete that the lie has become the very air you breathe, the very framework through which you perceive your own ambition. The lie is that your success is measured by a clock, not the clock on the wall, but a far more insidious one, a cognitive metronome installed in your mind at birth, its tempo set and reinforced by every institution you have ever trusted. It is the clock of the quarterly earnings report, the clock of the 24-hour news cycle, the clock of the next promotion, the next product launch, the next fiscal year. It is a clock that ticks with a frantic, desperate urgency, a rhythm that screams now, now, now. And this clock, this relentless psychological drumbeat, is the single most effective machine ever devised for the destruction of wealth. It is the clock that makes you poor. It is an operating system for mediocrity, a neurological prison that mistakes motion for progress and activity for achievement. It keeps the intelligent, the driven, and the ambitious running on a hamster wheel, sweating under the illusion of a marathon while never actually moving an inch. This is the world you inhabit. But it is not the world he inhabits. Warren Buffett, the chairman of Berkshire Hathaway, a man whose personal fortune is a rounding error away from $100 billion, does not hear this clock. He has, through a lifetime of deliberate, focused, and painful effort, performed a kind of cognitive surgery on himself. He has located this frantic, wealth-destroying metronome in his own mind, and he has silenced it. In its place, he has installed a different kind of clock, a strange clock, a silent clock, a clock whose hands do not measure seconds or hours, but decades and generations. It is a clock that operates on a perpetual time horizon. This is not a folksy aphorism. It is not a simple platitude about being patient. It is a complete, systematic, and ruthlessly effective cognitive operating system, a fundamental rewiring of the brain's relationship with the fourth dimension. It is the master algorithm that underpins every decision he has ever made. It is the source code of his genius. His ability to harness this strange perception of time is a weapon, a tool of such profound power that it borders on a superpower. It allows him to see value where others see only risk. It allows him to feel greed when others are paralyzed by fear. It allows him to sit still, sometimes for years, accumulating cash and knowledge while the rest of the world burns itself out in a frenzy of pointless activity. He does not simply invest for the long term, he has become the long term. He has achieved a state of supreme temporal detachment that allows him to systematically exploit the structural, psychological, and institutional short-sightedness of the entire capitalist system. He is playing a different game on a different field with a different set of rules, all because he is using a different clock. This documentary is a deconstruction of that clock. We are not here to talk about stock tips or financial metrics. We are here to dissect the psychological architecture that makes his results possible. We will reveal the three core pillars of this mental model: the great uninstall, the process of purging the short-term sickness from your cognitive DNA, the new architecture, the blueprint for installing the perpetual time horizon in your own mind, and the guardian at the gate, the behavioral protocols required to protect this new operating system from a world that will do everything in its power to destroy it. Prepare to uninstall the clock that makes you poor. It is time to learn the system for turning time itself into generational wealth. Welcome to the world beyond the ticking clock. Pillar 1. The Great Uninstall, erasing the short-term sickness. Before you can build, you must first demolish. Before you can install a new operating system, you must first identify and purge the viruses and malware that are corrupting your current one. For Warren Buffett, the journey to a perpetual time horizon did not begin with an act of creation, but with an act of radical subtraction. He understood, at a level deeper than almost any of his contemporaries, that the modern financial world is not a system for building wealth, but a machine for manufacturing short-term noise. It is a relentless, overwhelming, and psychologically devastating assault on the human capacity for rational, long-term thought. To survive, let alone prosper, you cannot simply ignore this machine. You must build a cognitive fortress against it. You must systematically identify, every input, every signal, every institutional pressure designed to shorten your time horizon, and you must ruthlessly cut it out of your life. This is not a passive process. It is an act of intellectual warfare. This first pillar is about deconstructing that war, about understanding the four primary enemies that Buffett has spent a lifetime vanquishing from his own mind. These are the horsemen of the short-term apocalypse: the ticker tape, the quarterly report, the macroeconomic forecast, and the delusion of market timing. To understand Buffett, you must first understand the ferocity with which he rejects these idols of the modern market. You must understand that his genius is not just in what he knows, but in what he chooses, deliberately and systematically, to ignore. Chapter 1. The ticker tape as a neurological weapon. Picture it in your mind. A relentless stream of green and red numbers flickering across a screen, up a quarter, down an eighth, unchanged. This is the ticker tape, the digital heartbeat of the market. And for 99.9% of the investing public, it is a river of pure, unadulterated poison. It is perhaps the most effective device ever invented for shortening the human time horizon. Warren Buffett understands this not as a financial analyst but as a cognitive psychologist. He sees the ticker tape for what it truly is: a neurological weapon aimed directly at the weakest parts of your brain. It is a machine designed to activate your most primitive, emotional, and self-destructive instincts. Every flicker of green is a tiny hit of dopamine, a rush of validation that whispers, "You were right, you are smart." Every flicker of red is a jolt of cortisol, a spike of fear that screams, "You were wrong, you are a fool, do something." This is not an environment for rational thought. This is a Skinner box for investors, conditioning you to react, not to think. It transforms the noble enterprise of owning a piece of a productive business into a mindless, high-stakes video game. The numbers on the screen cease to represent fractional ownership in real companies with factories, employees, and customers. They become abstract symbols in a game of gains and losses, detached from all underlying reality. This is what psychologists call affective forecasting error. The ticker tape forces you to constantly forecast how you will feel based on the next price movement, and your brain, hardwired for survival, will always prioritize avoiding the immediate pain of loss over pursuing the abstract pleasure of a long-term gain. Buffett's solution to this neurological assault is as simple as it is radical. He unplugs the machine. There are no, quote, screens in his office in Omaha. He has famously stated that if he were to be stranded on a desert island with a newspaper that only printed stock prices but no business news, he would be a wreck. But if he had the business news and no stock prices, he would do just fine. This is not a trivial preference, it is the cornerstone of his entire cognitive system. By refusing to watch the daily fluctuations of his holdings, he is performing a kind of psychological jujitsu. He is starving the emotional, reactive part of his brain, what Daniel Kahneman would call System 1, of the very data it feeds on. He is refusing to play the game. He is forcing his mind to operate entirely in the slow, deliberate, and rational domain of System 2. He is focused on the business, not the symbol. He is looking at the farm, not the forecast. He is judging the performance of his companies by their operational results, their earnings power, their competitive position, all of which unfold over years and decades, not by the manic depressive whims of a stock market that reprices its opinion every single second. This refusal to engage is not an act of ignorance. It is an act of profound intellectual discipline. He understands that the ticker tape is a source of information that has a negative value. The more you consume it, the poorer your decisions become. It is a fire hose of noise that systematically drowns out the quiet signal of long-term value creation. Let us be clear about the psychological stakes. Engaging with the daily noise of the market is not a neutral act. It actively rewires your brain. It shortens your attention span. It trains you to seek instant gratification. It anchors your perception of a company's worth to its last traded price, a number that is often the result of 1,000 random, emotional, and irrelevant factors. It creates what is known as myopic loss aversion, a psychological phenomenon where investors who check their portfolios frequently are more likely to see losses and are therefore more likely to feel the pain of those losses, leading them to take less risk and achieve lower long-term returns. Buffett's unplugged office is a carefully engineered cognitive environment designed to combat this very bias. He is creating a space where the long-term signal is the only thing that can be heard. He is choosing to receive information about his businesses on his own terms, through the slow, deliberate rhythm of annual reports and industry publications, not through the chaotic, seizure-inducing flicker of a quote machine. This is the first act of the great uninstall. It is the recognition that to think long-term, you must first create an environment where long-term thinking is even possible. You must recognize the ticker tape not as a tool, but as a weapon aimed at your own rationality. You must see it as a fire hose of cognitive poison, and you must have the discipline to turn it off. This single act, more than any complex financial calculation, is the first step toward installing Buffett's Perpetual Time Horizon. It is the clearing of the battlefield. It is the creation of a silence in which real thought can finally begin. Chapter 2: The 90-Day Prison, Deconstructing the Tyranny of Quarterly Capitalism. If the ticker tape is the daily instrument of torture for the short-term mind, then the quarterly earnings report is its holy scripture. It is the central organizing principle of modern Wall Street, a relentless 90-day cycle that has shackled the minds of chief executives, institutional investors, and financial journalists alike. It is a system that purports to provide clarity and accountability, but in reality it is a psychological prison, a framework that systematically punishes long-term thinking and rewards short-term illusion. Warren Buffett does not live in this prison. He views it from the outside, with a mixture of pity and contempt, recognizing it as one of the most structurally idiotic, wealth-destroying constructs in the history of commerce. And his refusal to participate in its rituals is the second, crucial act of his great uninstall. Let's dissect the architecture of this prison. Every 90 days, a public company is legally mandated to report its financial performance and host a conference call with Wall Street analysts. These analysts, whose careers depend on their ability to make short-term predictions, have already published their estimates for what the company's revenue and earnings per share should be. The entire game then revolves around a single absurd question: did the company beat or miss these arbitrary short-term targets? The actual long-term health of the business, its strategic positioning, its investment in research and development, its customer satisfaction, all of this becomes secondary to the theatrical performance of hitting a quarterly number. This creates a cascade of perverse incentives that are anathema to everything Buffett believes in. It forces CEOs to manage for the quarter, not for the decade. A CEO who knows that a major multi-year investment in a new factory or a new technology will depress earnings for the next few quarters, and thus cause the stock to fall and his own compensation to suffer, is heavily incentivized to avoid that long-term investment, even if it is the single best thing for the future of the company. Instead, he is incentivized to engage in a series of short-term tricks, cutting the R&D budget, delaying necessary maintenance, buying back stock at inflated prices, or engaging in accounting gimmickry to artificially smooth out earnings. They are, in essence, sacrificing the long-term health of the business on the altar of short-term perception. Buffett calls this the institutional imperative in action, the tendency for organizations to mindlessly imitate their peers no matter how foolish the behavior may be. He sees it as a kind of corporate insanity. And his response is to build an entire ecosystem, Berkshire Hathaway, that is explicitly designed to be an antidote to this disease. Berkshire Hathaway does not provide quarterly earnings guidance. Buffett and his partner, Charlie Munger, have been vocal in their disdain for the practice for over 50 years. They believe that promising a certain number to Wall Street is the first step on a slippery slope to corporate dishonesty. As Buffett has written, The CEO who is measured by Wall Street on his ability to make the numbers will eventually be tempted to make up the numbers. Furthermore, Buffett refuses to talk to Wall Street analysts. He holds one annual meeting, a marathon session, where he and Munger will answer questions from any shareholder for hours on end. But he does not engage in the quarterly dance of trying to manage the expectations of people whose time horizon is fundamentally misaligned with his own. He is, once again, controlling the flow of information and the terms of the conversation. He is communicating with his shareholders, his true partners, on an annual basis, through a long, detailed letter that focuses on the fundamental, long-term economic progress of Berkshire's myriad businesses. He is forcing the conversation back to what actually matters: durable competitive advantages, rational capital allocation, and the cultivation of a culture of trust. This is a profound act of cognitive liberation. By refusing to be judged on a 90-day clock, he frees both himself and the managers of Berkshire's subsidiary companies to think and act for the long term. The CEO of See's Candies or Nebraska Furniture Mart does not wake up in a cold sweat in the middle of March, worrying about whether they will make the quarter. They wake up thinking about how to strengthen their brand and widen their economic moat over the next 10 years. They are free to make investments that may not pay off for years, secure in the knowledge that their capital allocator in Omaha is not a prisoner of the 90-day clock. This creates an almost unassailable competitive advantage. While the rest of corporate America is locked in a frantic, short-term arms race, Berkshire can play the long game. It can acquire businesses that are temporarily out of favor. It can provide capital to companies in a crisis when no one else will. It can wait patiently for the perfect pitch. It can compound its advantages, year after year, decade after decade, insulated from the psychological storm that rages outside its walls. The lesson for the individual investor is profound. You must learn to see the quarterly earnings cycle for what it is, a source of noise, not signal. You must train your mind to ignore the breathless headlines about a company, beating estimates by a penny. You must learn to judge a business not by its performance over the last 90 days, but by its performance over the last decade and its prospects for the next. This requires a conscious, deliberate act of mental filtering. It means reading the annual report with far more care than the quarterly release. It means focusing on the long-term trends in return on invested capital, not the short-term fluctuations in earnings per share. It means asking yourself, is this management team building a stronger business for the long haul, or are they simply playing the Wall Street game? By deconstructing the tyranny of quarterly capitalism in your own mind, you take the second critical step in the great uninstall. You begin to liberate yourself from the institutional framework that is designed, from the ground up, to keep you thinking small and thinking short. You begin to align your own mental clock with the clock of true business value, a clock that measures its progress in years, not fiscal quarters. Chapter 3. The Seduction of the Seer. Why Buffett Abhors Macroeconomic Prophecy. There is a certain kind of intellectual comfort in the act of prediction. To forecast the future, whether it be the weather, the outcome of a sports game, or the direction of the economy, is to create an illusion of control over an uncertain world. This desire is deeply human. And in the world of finance, it has spawned a multi-billion-dollar industry of professional seers, the macroeconomic forecasters. These are the high priests of the market, the economists and strategists, who appear on financial television and in the pages of prestigious journals to offer their solemn predictions about next year's gross domestic product, the level of interest rates, the price of oil, or the direction of the stock market. Their pronouncements are treated with a reverence bordering on the biblical. And Warren Buffett believes they are, almost without exception, a complete and utter waste of time. His systematic rejection of macroeconomic forecasting is the third pillar of his great uninstall, and it is perhaps the most intellectually challenging for the aspiring elite to accept. We are trained to believe that to be smart is to have an opinion on the big picture. Buffett's genius lies in his recognition that this is a cognitive trap. He understands that the future is fundamentally, irrevocably, and beautifully unknowable, and any attempt to base investment decisions on a specific prediction about the macroeconomic future is not just a flawed strategy, It is a gateway to psychological ruin. Let us first examine the sheer futility of the exercise. Buffett has often pointed out that if he had listened to the economic forecasts of the early 1960s, he would have never invested a dime. The consensus at the time was filled with fears of nuclear war, Cold War tensions, and domestic strife. Yet the subsequent 30 years were a period of almost unprecedented prosperity for American business. Conversely, the giddy optimism of the late 1990s, when forecasters spoke of a new economy and a long boom, was immediately followed by the dot-com crash and a painful recession. The track record of macroeconomic forecasters is, to put it mildly, abysmal. The economist John Kenneth Galbraith once quipped, "There are two kinds of forecasters, those who don't know, and those who don't know, they don't know." Buffett resides firmly in the first camp. He has built a $90 billion fortune on a foundation of profound, intellectual humility. He starts with the simple, powerful admission, "I don't know. I don't know what the economy will do next year. I don't know where interest rates will be. I don't know who will win the next election." And the liberating truth is, I don't have to. This is the critical insight. Buffett's entire investment philosophy is designed to be robust to macroeconomic uncertainty. It is an operating system that renders prediction unnecessary. Instead of trying to predict the rain, he focuses on building an ark. He does this by focusing his attention not on the macro, but on the micro. He is not asking, what will the economy do? He is asking, will people be drinking Coca-Cola in 20 years? Will they be using American Express cards? Will they need insurance from Geico? He is searching for businesses with such powerful, durable competitive advantages, such wide economic moats, that they can prosper in almost any economic environment. A great business, in Buffett's view, is one that can navigate both recessions and booms, high inflation and low inflation, Democratic presidents and Republican presidents. Its success is determined by its own internal strengths, not by the shifting tides of the macroeconomic sea. This focus on the microeconomic, the specific business, is a powerful antidote to the short-term thinking that forecasting inevitably encourages. A macroeconomic forecast is almost always about the next 6 to 18 months. It forces your mind into a short-term frame. A deep analysis of a specific business's competitive moat, by its very nature, forces you to think in terms of decades. You are asking questions about the durability of a brand, the scalability of a network effect, the long-term cost advantages of a particular production process. You are, in essence, replacing the futile act of prediction with the productive act of analysis. But there is a deeper psychological reason for Buffett's aversion to forecasting. He understands that making a prediction, even a private one, creates a dangerous attachment. Once you have publicly or privately declared that you believe the market is going down, your ego becomes invested in that outcome. You will start to seek out information that confirms your belief, confirmation bias, and ignore information that contradicts it. You will be psychologically primed to sell at the bottom, just to prove yourself right, even if the rational decision is to buy. By refusing to make a prediction in the first place, Buffett keeps his mind open, flexible, and objective. He is free to react to reality as it is, not as he predicted it would be. He can buy a wonderful business at a fair price, regardless of what the headline economic news of the day might be. Think about the mental freedom this creates. While the rest of the world is agonizing over the latest jobs report, or the minutes from the last Federal Reserve meeting, Buffett is calmly reading the annual report of a furniture company in Nebraska. He is not wasting a single calorie of cognitive energy on questions that are both unanswerable and, in the long run, irrelevant. This is the third act of the great uninstall, the deliberate cultivation of macroeconomic ignorance. It is the recognition that the quest for certainty about the big picture is a siren song that leads only to the rocks of short-term speculation. It is the discipline to say, "I don't know and I don't care," and to instead focus your entire intellectual firepower on the one thing you can know, the long-term, fundamental economics of a specific business. This is how you escape the forecasting game and take another crucial step toward the perpetual time horizon. Chapter 4: The Poison of Action Bias, Escaping the Market Timer's Delusion. The human brain is a machine built for action. For hundreds of thousands of years on the savannah, our survival depended on our ability to react quickly to threats and opportunities. The rustle in the grass demanded a response, fight or flight. The sight of a fruit tree demanded action, climb and gather. This deep-seated instinct, this action bias, served our ancestors well. In the modern stock market, it is a recipe for absolute disaster. The delusion of market timing, the belief that one can skillfully dance in and out of the market, buying at the bottoms and selling at the tops, is the ultimate expression of this destructive bias. It is the final and perhaps most seductive idol that must be smashed in the great uninstall. And Warren Buffett's entire life is a testament to the power of its opposite: profound, strategic, and often agonizingly difficult inaction. Market timing is seductive because it appeals to our ego and our desire for control. It feels smart, it feels proactive, it feels like we are doing something. The financial media fuels this delusion, constantly parading experts who claim to have called the bottom or predicted the crash. The reality, as decades of academic research and real-world results have shown, is that successful market timing is statistically indistinguishable from sheer luck. To time the market correctly, you have to be right twice. You have to know when to sell, and you have to know when to get back in. Missing just a few of the market's best days can have a catastrophic impact on your long-term returns. A famous study by Fidelity showed that if an investor had stayed fully invested in the S&P 500 from 1980 to 2018, they would have earned an average annual return of 11.5%. But if they had missed just the 10 best days during that 38-year period, their return would have plummeted to 5.4%. Miss the 30 best days, and the return drops to a paltry 1.6%. The cost of being on the sidelines is simply too high. Buffett understands this at a mathematical level, but more importantly, he understands it at a psychological level. He knows that the very act of trying to time the market fundamentally corrupts the investor's mindset. It shifts the focus from owning a piece of a productive business to betting on short-term price movements. It turns you from a business owner into a gambler. It forces you to operate on the market's clock, reacting to its every whim rather than on your own long-term clock. Buffett's antidote to this poison is his famous analogy of the, quote, 20-slot punch card. He advises investors to imagine that they have a punch card with only 20 punches on it for their entire lifetime. Every time they make an investment, they have to punch one of those slots. This is not a literal rule, but a powerful psychological device. It is a forcing function for extreme selectivity and extreme patience. If you only have 20 decisions to make in your entire life, you are not going to waste one on a short-term bet. You are not going to trade in and out of a stock based on a gut feeling or a news headline. You are going to wait, and wait, and wait. You will wait for an opportunity that is so compelling, so obvious, so overwhelmingly in your favor, that it feels like a certainty. You will do a mountain of research. You will think about the business from every possible angle. You will wait for the price to be so attractive that you can't possibly say no. And then, when you finally act, you will act with immense conviction and size. This is the essence of Buffett's approach. He is a master of what we might call weaponized patience. He is perfectly comfortable doing nothing for months or even years on end. During the dot-com bubble of the late 1990s, when the rest of the world was caught up in a speculative frenzy, Buffett was widely mocked as a dinosaur who had lost his touch. Berkshire Hathaway's stock lagged the market significantly, but Buffett refused to play the game. He admitted he didn't understand the new technology stocks, and he refused to invest in what he didn't understand. He sat patiently on a growing mountain of cash. And then, when the bubble burst, he was there, with his capital and his wits intact, to pick up the pieces, buying wonderful businesses at bargain prices. This ability to sit still, to resist the siren song of action, is perhaps his most underrated skill. It is a form of discipline that is deeply counterintuitive and deeply countercultural. We live in a society that celebrates hustle, that equates activity with progress. Buffett's career is a powerful rebuke to this ethos. He has proven that in the world of investing, your results are often determined not by the brilliant moves you make, but by the stupid moves you consistently and systematically avoid. The final act of the great uninstall, therefore, is the internalization of this principle. It is the slaying of the action bias. It is the acceptance that the default state for a wise investor is inaction. It is the development of a mindset that views activity with suspicion and patience as a strategic weapon. You must learn to love boredom. You must train yourself to find satisfaction in the slow, patient accumulation of knowledge, not in the frantic clicking of a mouse. By purging the delusion of market timing from your mind, you complete the demolition process. You have silenced the ticker tape, escaped the 90-day prison, rejected the false prophets of macroeconomics, and conquered the innate, destructive urge to do something. The ground is now clear. The old, corrupted operating system has been erased. You are now ready to build. You are now ready to install the new architecture, the Perpetual Time Horizon. Pillar 2. The new architecture, installing the Perpetual Time Horizon. Having cleared the cognitive debris of short-term thinking, we now arrive at the heart of the matter, the construction of a new mental model. This is not about learning a new set of facts, but about forging a new way of seeing. Installing the Perpetual Time Horizon is an act of profound psychological engineering. It is the deliberate process of rewiring your brain to operate on a different temporal plane, to see the world not as a series of fleeting moments, but as a long, unbroken chain of cause and effect. This is where Buffett's true genius resides, not in his ability to pick stocks, but in his ability to architect a mind that is immune to the ravages of time and impatience. This new architecture rests on 4 foundational pillars, 4 cognitive tools that, when combined, create the unshakable long-term conviction that defines his approach. We will explore the forever holding period as a powerful filtering mechanism. We will deconstruct his view of compounding, seeing time not as an obstacle but as a powerful business partner. We will examine the psychological alchemy that transforms market volatility from a terrifying threat into a welcome opportunity. And we will anchor it all in a detailed case study, the acquisition of See's Candies, a story that serves as the Rosetta Stone for understanding how this entire operating system works in practice. This is the blueprint. This is how you build a mind that can turn time into money. Chapter 5: The Forever Filter: How a Single Word Transforms Decision-Making. Our favorite holding period is forever. It is perhaps Warren Buffett's most famous quote. It is often treated as a piece of folksy wisdom, a charming but ultimately impractical ideal. This is a profound misinterpretation. The word forever is not a suggestion. It is a weapon. It is the single most powerful cognitive filter in Buffett's entire arsenal. It is a forcing function of such brutal elegance that it instantly changes the entire nature of the investment decision. It is the master switch that activates the Perpetual Time Horizon. Let's break down the mechanics of this filter. Imagine you are considering buying a stock. If your expected holding period is 1 year, what questions will you ask? You will likely focus on short-term catalysts. Will the next earnings report be good? Is there a new product launch coming up? What is the current market sentiment? Your analysis will be shallow, tactical, and focused on predicting the immediate future. Now, apply the forever filter. Imagine you are not allowed to sell this business for the rest of your life. You are, in essence, marrying it. The questions you ask will change dramatically. They will become deeper, more strategic, and more profound. You are no longer asking, what will the stock price do next year? You are asking, what will this business look like in 20, 30, or 50 years? Does it have a durable competitive advantage and economic moat that can withstand the relentless assaults of competition for decades? Is the management team not only competent, but also trustworthy, the kind of people you would want to be in business with for the rest of your life? Does the business have the ability to reinvest its earnings at high rates of return, allowing the power of compounding to work its magic over a very long period? Does the business operate in an industry that is likely to be larger and more important in the future, or is it facing terminal decline? Suddenly, all the short-term noise we discussed in the first pillar, the quarterly earnings, the economic forecasts, the daily stock price fluctuations, becomes utterly irrelevant. It is like planning a lifelong marriage based on what your potential partner is wearing today. It's absurd. The forever filter forces you to elevate your thinking from that of a speculator to that of a true business owner. You are no longer renting a stock. You are buying a piece of a business to hold for the rest of your life. This has a powerful clarifying effect. It instantly eliminates 99% of the investment opportunities out there. Most companies cannot withstand the scrutiny of the forever filter. They are mediocre businesses, fad-driven companies, or firms with no lasting competitive advantage. Applying this filter is an act of intellectual honesty. It forces you to confront the true long-term prospects of a business, stripped of all the hype and short-term storytelling. Furthermore, the forever filter fundamentally changes your relationship with price. When you are thinking about holding a business forever, the price you pay for it becomes critically important, but in a very specific way. You are not trying to buy it at a price that you can flip for a profit in 6 months. You are trying to buy it at a price that provides you with a satisfactory long-term return on your investment, as if you were buying the entire company yourself. This leads directly to Buffett's concept of Mr. Market. When you have a clear, long-term view of a business's intrinsic value, the daily fluctuations of the stock market are no longer a source of stress. They become a source of opportunity. You know what the business is worth to you over the long term. If the manic-depressive Mr. Market offers to sell it to you at a significant discount to that value, you buy. If he offers to buy it from you at a ridiculous premium, you might consider selling, though your preference is always to hold. But on most days, when his prices make no sense, you simply ignore him. The forever filter is what gives you the power to do that. It is the anchor of intrinsic value that holds you steady in the storm of market emotion. Let's be clear, forever is an aspiration, not a commandment. Buffett has sold businesses when their long-term competitive dynamics have changed for the worse, or when he has found a much better opportunity. But the key is that he begins with the assumption of forever. The burden of proof is on the decision to sell, not the decision to hold. This simple inversion is the secret. The default setting for most investors is activity. Their default is to constantly be looking for the next trade. Buffett's default setting is inertia. This is a mindset that must be cultivated. It requires a conscious effort to fight against the brain's natural desire for novelty and action. You must train yourself to ask the hard, long-term questions. You must have the discipline to say no to thousands of mediocre ideas. You must develop the conviction to buy a business with the intention of never selling it. By installing the forever filter as the first and most important screen in your investment process, you are laying the foundational stone of the new architecture. You are building a mental framework that is, by its very design, oriented toward the long term. You are starting to run on perpetual time. Chapter 6: The Alchemist's Engine, Seeing Time as a Partner, Not an Opponent. For most people, time is an enemy. It is the force that creates deadlines, that causes decay, that limits our opportunities. We are constantly trying to beat the clock, to save time, to find shortcuts. In the world of investing, this manifests as an obsession with speed. How can I get rich quick? What is the hot stock that will double in the next month? This mindset is a direct path to ruin. Warren Buffett's perception of time is the complete inversion of this. For him, time is not an adversary. Time is the single most powerful and reliable partner in his entire enterprise. His entire strategy is designed to harness the relentless, elemental force of time and put it to work on his behalf. This is achieved through his profound understanding of the eighth wonder of the world, compounding. The concept of compound interest is simple to understand mathematically, but it is almost impossible for the human brain to grasp intuitively. Our minds evolved in a linear world. We think in terms of addition, not multiplication. If you walk for an hour, you travel a certain distance. If you walk for 2 hours, you travel twice that distance. Compounding does not work like that. It is a process of geometric progression, where growth builds upon previous growth, leading to an explosive, exponential outcome over long periods. Albert Einstein is reputed to have called it the most powerful force in the universe. Buffett calls it the key to his success. He understood this from an incredibly young age. The stories of him as a boy, calculating how a small sum of money would grow over decades, are legendary. He was not just doing math, he was internalizing a worldview. He was programming his mind to see the world through the lens of compounding. This lens changes everything. When you truly understand compounding, you realize that the single most important variable in the equation is not the rate of return, but the length of time you can let it run. A good return held for a very long time will always beat a spectacular return held for a short time. This is why Buffett is not a trader. It is why his favorite holding period is forever. Every time you sell a great business, you are interrupting the process of compounding. You are resetting the clock. You are not only incurring taxes and transaction costs, but you are also giving up your share in a machine that is automatically generating wealth for you over time. Buffett's goal is to find these incredible compounding machines, businesses like Coca-Cola, American Express, or See's Candies, and then to do as little as possible. His job is to buy them at a sensible price, and then let his partner, time, do the heavy lifting. He is not trying to outsmart the market on a daily basis. He is trying to align himself with the unstoppable force of long-term value creation. But Buffett's concept of compounding goes beyond just money. He applies it to knowledge as well. He calls it building a latticework of mental models. Every day, he spends hours reading, not just about business, but about history, psychology, science, and biography. He is not just accumulating facts. He is slowly, patiently, weaving these facts into a coherent mental framework. Each new piece of knowledge connects to the old, strengthening the overall structure. Like financial compounding, the returns on this cognitive compounding are not linear. The more you know, the easier it is to learn new things. The more models you have in your head, the better your decisions become. His wisdom is not the result of a single brilliant insight, but the accumulated interest on a lifetime of disciplined learning. To install this part of the new architecture, you must fundamentally change your relationship with time. You must stop seeing it as an enemy to be conquered and start seeing it as a partner to be courted. This requires a shift from a mindset of hunting to a mindset of farming. A hunter is looking for a quick kill. A farmer carefully prepares the soil, plants a seed, nurtures it, and then waits patiently for the harvest. An investor who thinks like a hunter is always looking for the next hot tip, the next trade. An investor who thinks like a farmer is looking for a wonderful business to own for a very long time, a fertile piece of ground where the seeds of capital can compound for decades. This mindset shift is profound. It breeds patience. It breeds discipline. It forces you to focus on the quality of the soil, the underlying business, rather than the short-term weather patterns of the market. You begin to understand that the greatest returns are not earned by brilliant flashes of insight, but by the quiet, relentless, and often boring process of letting a great business do what it does best, year after year. This is the alchemist's engine. It is the mental machinery that transmutes the base metal of time into the gold of generational wealth. It is the recognition that the most powerful force in the universe is on your side, if only you have the wisdom to get out of its way. Chapter 7. The Alchemical Inversion. How to Transform Market Chaos into Raw Opportunity. For the average investor, a stock market crash is a moment of pure terror. It is the visceral, stomach-churning confirmation of their worst fears. The red on the screen is not just a number, it is a judgment. It is a sign of failure, a threat to their financial security, a source of profound anxiety. The instinctive reaction is to flee. to sell everything, to make the pain stop. For an investor operating on a perpetual time horizon, a stock market crash is the equivalent of a Christmas sale. It is a moment of rare and wonderful opportunity. It is the time to get greedy when others are fearful. This psychological alchemy, this ability to invert the emotional response to volatility, is the third and most powerful component of the new architecture. It is the ultimate stress test of whether you have truly installed the long-term mindset. This inversion is not possible without the first two components we have discussed. It is only because you have applied the forever filter and have a deep understanding of a business's long-term intrinsic value that you can view a collapsing stock price with equanimity. It is only because you see time as your partner that you can welcome a setback that allows you to buy more of a great business at a lower price, thereby increasing your long-term rate of compounding. The key to this mental model is the clear and unwavering distinction between price and value. Value is what a business is fundamentally worth over the long term. Price is simply what someone is willing to pay for it on any given day. In the short run, price can diverge wildly from value, driven by fear, greed, and mass delusion. In the long run, price will inevitably converge with value. Buffett's entire strategy is to exploit this temporary divergence. He spends his quiet periods, when the market is calm or euphoric, calculating the intrinsic value of the businesses on his watch list. He does his homework. He builds his conviction. He determines the price at which he would be delighted to own a piece of these companies. Then he waits. He waits for Mr. Market to have one of his periodic psychotic episodes. He waits for a financial crisis, a recession, a panic. He waits for the moment when the short-term focused world is selling indiscriminately, when the price of wonderful businesses becomes detached from their long-term value. And then, with the courage of his conviction, he acts. He steps into the storm and buys. His famous investment in American Express in the 1960s during the Salad Oil scandal is a classic example. The company was thought to be on the brink of bankruptcy because one of its clients had defaulted on a massive loan secured by phantom vats of salad oil. The market panicked, and the stock was crushed. But Buffett didn't panic. He went out and did the field work. He visited restaurants and banks. He observed that customers and merchants were still using American Express cards and travelers' checks. He concluded that the fundamental value of the brand, its powerful economic moat, was still intact. The scandal was a huge but ultimately survivable financial hit. While Wall Street was selling in a frenzy, Buffett invested 40% of his partnership's capital into the company and made a fortune as the stock recovered. He was able to do this because his time horizon was different. The rest of the world was asking, what will happen to American Express in the next 6 months? Buffett was asking, will American Express still be a dominant franchise in 10 years? By asking a better question, he got a better answer. To cultivate this mindset, you must deliberately reframe your perception of volatility. You must stop seeing it as risk and start seeing it as opportunity. Risk, in Buffett's definition, is the permanent loss of capital. Volatility is simply the up and down movement of a stock price. They are not the same thing. In fact, for the long-term investor, volatility is the friend that periodically offers you the chance to buy value at a discount. This requires a strong stomach and a deep well of emotional resilience. You must be willing to look wrong in the short term to be right in the long term. You must be able to buy a stock and watch it go down further, secure in the knowledge that you have purchased a piece of a great business at a price below its long-term worth. This is the pinnacle of the long-term mindset. It is the moment when you are truly liberated from the emotional tyranny of the market. It is the alchemical transformation of fear into fortune, when you can genuinely, honestly, and joyfully say, I hope the market goes down so I can buy more. You have successfully installed the perpetual time horizon. You have completed the new architecture. You are no longer a victim of the market's clock. You are its master. Chapter 8. The Seas Candy's Rosetta Stone, a multi-decade masterclass in time arbitrage. Theory is one thing. But to truly understand a mental model, we must see it in action. The 1972 acquisition of See's Candies is perhaps the single most important transaction in Warren Buffett's career. It is not the largest or the most famous, but it is the one that forever changed his cognitive operating system. It was the moment he fully graduated from the cigar-butt investing of his mentor, Ben Graham, to the wonderful business at a fair price philosophy that would define his legacy. The story of See's Candies is the Rosetta Stone for deciphering the Perpetual Time Horizon. It is a living, breathing, chocolate-covered case study in time arbitrage. In the early 1970s, Buffett and Munger were presented with the opportunity to buy See's Candies, a beloved California-based chocolate company. The business was a gem. It had a fanatically loyal customer base, a powerful brand built over decades, and a simple, understandable product. The company earned about $2 million a year after tax, and it required very little capital to run. The sellers were asking for $30 million. Buffett's initial reaction, programmed by years of Graham's deep value approach, was that the price was too high. $30 million for a company earning $2 million was a price-to-earnings ratio of 15. It also represented a significant premium to the company's tangible assets, its book value. The old Buffett, the Buffett of the 1950s and 60s, would have walked away. The deal was not statistically cheap. But Charlie Munger pushed him. Munger saw something that Buffett was just beginning to grasp: the incredible value of an intangible asset, a powerful brand that resided in the minds of its customers. See's had pricing power. Because customers loved the brand and associated it with quality and nostalgia, the company could raise its prices year after year to cover inflation and then some, without losing business. This brand was an economic moat, a fortress that protected the company from competition. Buffett, persuaded by Munger, reluctantly agreed to the $30 million price, later admitting it was one of the best decisions he ever made. He paid $25 million. Here is where the Perpetual Time Horizon comes in. A short-term investor, looking at the numbers in 1972, would have seen an expensive company. But Buffett and Munger were not buying 1 year's earnings. They were buying a perpetual cash-generating machine. They were looking out over decades. Let's look at what happened. Over the next 40-plus years, See's Candies would go on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring very little additional capital investment. That initial $25 million purchase became one of the greatest investments of all time. The power of the brand, the economic moat, allowed See's to raise prices year after year, turning a simple chocolate business into a gusher of cash that Buffett could then reinvest into other wonderful businesses. The See's acquisition taught Buffett a critical lesson that would inform all of his future mega deals, from Coca-Cola to Apple. The lesson was that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. A fair company, a cigar butt, might give you one good puff of profit, but a wonderful company, one with a durable competitive advantage, can compound your wealth for a lifetime. This is the essence of time arbitrage. Buffett was able to see the multi-decade value of the See's brand, while other, more conventional investors were fixated on the statistical cheapness of the company's tangible assets in that single moment in time. He was operating on a different clock. He was willing to pay a fair price in 1972 in exchange for decades of predictable, growing, and high-return cash flow. This case study perfectly illustrates the synthesis of our new architectural pillars. The forever filter. Buffett and Munger bought See's with the intention of holding it indefinitely, which forced them to focus on the long-term durability of the brand. Time as a partner. They understood that the true value of See's would be unlocked by the power of compounding over many decades. The inversion of volatility. While there was no market crash in this case, the principle applies. They were willing to pay a price that seemed high to others because they had a firm conviction in the long-term intrinsic value, a value that was invisible to those with a shorter time horizon. The See's Candies story is the ultimate proof of concept. It is the tangible result of a mind that has been rewired to see time not as a limitation, but as the ultimate raw material for wealth creation. It is the beautiful, profitable, and delicious consequence of installing the Perpetual Time Horizon, It is the model for everything that was to come. Pillar 3. The Guardian at the Gate, the psychology of perpetual stewardship. It is not enough to simply build a new cognitive architecture. A fortress, no matter how well designed, is useless without a vigilant garrison to defend it. The world will not applaud your decision to adopt a perpetual time horizon. In fact, it will actively conspire to destroy it. The pressure to conform, the siren song of the crowd, the constant bombardment of short-term noise, these forces are relentless. The third and final pillar of Buffett's system is therefore not about analysis, but about character. It is about the cultivation of a specific set of behavioral protocols and psychological traits that act as the guardians at the gate of your long-term mind. This is the realm of temperament, the domain of what Charlie Munger calls worldly wisdom. It is the understanding that in investing, once you have mastered the basics, your greatest enemy is not the market, but yourself. This final pillar is about forging the inner psychology required to protect your newly installed operating system from the most dangerous threat of all, your own flawed human nature. We will explore the 3 essential guardians of the long-term mind: the discipline of profound inaction, the liberation of a decoupled ego, and the unshakable foundation of an inner scorecard. These are the traits that allow Buffett to not just think long-term but to live it, day after day, decade after decade, in a world that is screaming for him to do the opposite. Chapter 9. The Zen of Inaction, Engineering a Mind that Thrives on Boredom. Our modern culture is a cult of action. We are taught from a young age that busyness is a virtue. Our calendars are filled, our inboxes are overflowing, and our social media feeds are a testament to our constant motion. We are addicted to the feeling of being productive, even when that productivity is an illusion. In the world of investing, this cultural programming is lethal. It manifests as a constant itch to tinker, to trade, to check, to do something. Warren Buffett's temperament is the absolute antithesis of this. He is a grandmaster of sitting still. He has engineered a mind that is not only comfortable with boredom, but actively seeks it out as a strategic advantage. This is the first guardian at the gate, the Zen of inaction. Buffett's daily schedule is famously empty. He does not have back-to-back meetings. He is not rushing from one conference call to the next. He spends the vast majority of his day, up to 80%, by his own estimation, sitting in his office and reading. This is not a sign of laziness, it is a sign of profound discipline. He understands that great investment ideas are rare, and that the process of identifying them requires long, uninterrupted periods of deep thought. He is creating the cognitive space necessary for insight to emerge. The rest of the world is so busy chopping wood that they never have time to sharpen the axe. Buffett spends most of his time sharpening the axe. This ability to do nothing is not a passive state, it is an active strategic choice. It is the behavioral manifestation of the 20-slot punch card we discussed earlier. By committing to a life of extreme selectivity, he is forced into a state of perpetual patience. He is a hunter who is willing to sit in his blind for days, weeks, or even months, waiting for the perfect high-probability shot. He knows that firing at every shadow that moves will only scare away the real prize. This mindset is incredibly difficult to cultivate. The human brain craves novelty and stimulus. Boredom can feel like a form of mental torture. The pressure to act, both internal and external, is immense. Your friends are talking about the hot new stock they just bought. The financial news is screaming about the latest market move. The temptation to join the fray is almost overwhelming. Buffett's defense against this pressure is twofold. First, he has structured his environment to minimize distractions. His office in Omaha is famously modest and geographically isolated from the frantic energy of Wall Street. He is, as we've discussed, a master of filtering out noise. He has created a sanctuary for slow thinking. Second, and more importantly, he has a deep philosophical conviction in the power of his process. He trusts that by focusing on reading, learning, and waiting for the obvious opportunity, he will achieve better results than those who are constantly churning their portfolios. He has seen the evidence of this over a 70-year career. His patience is not born of apathy, but of confidence. So how does one engineer a mind that thrives on boredom? It begins with a conscious reframing of what constitutes productive work for an investor. You must come to believe, in your bones, that reading and thinking are the high-leverage activities, and that trading is the low-leverage, low-return activity. You must learn to derive satisfaction from the quiet accumulation of knowledge, not from the adrenaline rush of a trade. This can be aided by practical habits. Schedule time in your calendar for nothing but reading and thinking. Create a do-not-disturb environment for yourself. Develop a watch list of wonderful businesses and spend your time getting to know them inside and out so that you are prepared to act when the opportunity arises. The goal is to substitute the mindless activity of trading with the purposeful activity of learning. This is the discipline of the non-doer. It is the understanding that in investing, as in many areas of life, what you don't do is often more important than what you do. It is the quiet, unglamorous, and deeply powerful practice of waiting. It is the first and most essential guardian, protecting the perpetual time horizon. It is the simple, profound, and profitable art of sitting still. Chapter 10: The Infinite Game: Decoupling Ego from Short-Term Results. The human ego is a fragile and demanding thing. It craves validation. It fears criticism. It seeks to be right, here and now. When this powerful psychological force is attached to the short-term performance of a stock portfolio, the results are almost always catastrophic. An investor whose ego is tied to their daily profit and loss statement is an emotional wreck waiting to happen. They will feel like a genius when their stocks are up, leading to overconfidence and reckless risk-taking. They will feel like a fool when their stocks are down, leading to panic selling at the worst possible moment. Their decisions will be driven not by logic and analysis, but by the need to protect their fragile sense of self-worth. Warren Buffett's psychological genius lies in his ability to have almost completely decoupled his ego from his short-term investment results. He does not view investing as a series of finite games to be won or lost, but as a single, continuous, infinite game. This is the second guardian at the gate. The concept of finite and infinite games was articulated by the philosopher James P. Carse. A finite game is played for the purpose of winning. It has a clear beginning and end, fixed rules, and a winner and a loser. A football game is a finite game. An infinite game, by contrast, is played for the purpose of continuing the play. The rules are changeable, and there are no winners or losers. Only players who drop out when they run out of the will or resources to continue. The goal is not to win, but to keep playing. Buffett is an infinite game player operating in a world of finite game players. The finite game player is obsessed with winning the quarter, beating the market this year, proving they are smarter than the next person. Their ego is on the line with every tick of the stock market. Buffett's goal is simply to stay in the game, to keep compounding his capital and his knowledge for as long as possible. He knows that if he can do that successfully over a very long period, the results will take care of themselves. This infinite game mindset is the psychological foundation for the perpetual time horizon. If your goal is to play for a lifetime, you are naturally going to make decisions that are sustainable over a lifetime. You will prioritize survival over short-term glory. You will avoid leverage in situations with a small chance of a catastrophic outcome because you know that you cannot afford to be knocked out of the game. As Buffett famously says, rule number 1, never lose money. Rule number 2, never forget rule number 1. He is not saying that his stocks will never go down in price. He is saying that he avoids decisions that could lead to the permanent impairment of his capital base, the kind of mistake that would force him to stop playing the infinite game. How does one cultivate this mindset? It starts with a focus on process over outcome. A finite game player judges themselves by the outcome. Did the stock go up? An infinite game player judges themselves by the process. Did I make a rational, well-researched decision based on my long-term framework? If you make a good decision, and the stock goes down in the short term due to market randomness, The infinite game player does not beat themselves up. They recognize that over the long term, a sound process will lead to good outcomes. This decoupling of process from short-term outcome is a powerful emotional insulator. It allows you to operate with a degree of objectivity and calm that is impossible for the ego-driven finite game player. It allows you to admit mistakes quickly because a mistake is simply a flaw in the process to be corrected, not a reflection on your fundamental worth as a person. It allows you to learn from your errors rather than rationalize them. Buffett is a master of this. In his annual letters, he is often more candid about his mistakes of omission and commission than he is about his successes. He is constantly refining his process, learning from experience, and strengthening his ability to keep playing the game. This is the psychological liberation that comes from playing the infinite game. It is the understanding that the real prize is not to be the smartest person in the room for a day, but to be the person who is still in the room, still learning and compounding, 50 years from now. This egoless, process-driven mindset is the second guardian of the long-term mind. It is the emotional fortitude required to withstand the inevitable slings and arrows of outrageous fortune and to keep playing the only game that matters. Chapter 11. The Internal Clock. Running on an inner scorecard in a world of external timers. We live in a world that is obsessed with external validation. From likes on social media to performance reviews at work, we are constantly being measured, judged, and ranked by others. This creates what Buffett calls an outer scorecard mentality. A person who lives by an outer scorecard derives their sense of self-worth from the applause of the crowd. Their decisions are shaped by a constant, nagging question. What will other people think? This is a psychological prison. For an investor, it is a death sentence. An investor who operates on an outer scorecard is a slave to market sentiment. They buy popular stocks at the peak of a bubble because it feels safe and consensus-driven. They sell sound businesses during a panic because they are terrified of looking foolish. Their time horizon is determined not by their own analysis, but by the fleeting, hysterical mood of the crowd. The final and most important guardian at the gate is the deliberate cultivation of its opposite, the inner scorecard. A person who lives by an inner scorecard has their own set of internal, unchanging principles. They judge themselves by their own standards, by their adherence to their own rational process. They are not indifferent to the opinions of others, but they are not controlled by them. Their central question is not, "What will others think?" but, "Have I acted with intelligence and integrity, according to my own best judgment?" This is the psychological bedrock of Warren Buffett's entire life. His ability to stand apart from the crowd, to be greedy when others are fearful and fearful when others are greedy, is a direct result of his unwavering commitment to his own inner scorecard. He would rather be right for the right reasons and have the whole world think he is wrong, than be wrong for the wrong reasons and get lucky with the applause of the crowd. The inner scorecard is the internal clock that allows you to run on perpetual time, even when the entire world is screaming at you to check your watch. It is the source of the conviction needed to buy a stock that everyone else hates. It is the source of the patience needed to hold a business through years of underperformance, secure in the knowledge that its long-term value is intact. It is the source of the integrity needed to walk away from a deal that doesn't meet your standards, no matter how much pressure you are under to do something. Developing an inner scorecard is the most difficult and personal work an investor can do. It cannot be learned from a textbook. It must be forged in the fires of experience. It requires deep self-knowledge, a clear articulation of your own principles and values, and the courage to stick to them under pressure. It begins with the simple act of writing down your investment philosophy. What are your rules? What are your criteria for buying a business? What are your criteria for selling? This written document becomes your constitution, a fixed point of reference in a chaotic world. When you are tempted to deviate from your plan out of fear or greed, you can return to it and ask yourself, does this action align with my own stated principles? It also requires a conscious effort to surround yourself with people who reinforce an inner scorecard mentality. Buffett's 50-year partnership with Charlie Munger is the ultimate example of this. They are two minds running on the same internal clock, constantly checking each other's thinking and reinforcing their shared commitment to rationality and long-term principles. They have created a two-person ecosystem of sanity in an often insane world. This is the final guardian. The inner scorecard is the culmination of the entire process. It is the psychological state that allows you to serenely execute on the principles of the perpetual time horizon. It is the quiet confidence that comes from knowing you are running your own race according to your own rules on your own time. When you can look at a sea of red on your screen and feel calm, not because you are emotionless, but because you have a deep, process-driven conviction in the long-term value of what you own, you have achieved it. You have built the fortress, and you have trained the guardians. You have achieved a state of cognitive sovereignty. You are no longer a slave to the ticking clock. You are its master. Conclusion: the world beyond the clock. We began this journey with a simple, provocative claim that you have been programmed with a defective clock, a mental operating system that keeps you trapped in a cycle of short-term thinking and guarantees mediocrity. We have deconstructed this prison, revealing its architecture in the form of the ticker tape, the quarterly report, the macroeconomic forecast, and the siren song of action. We have laid out the blueprint for a new cognitive architecture, a new way of perceiving and weaponizing time itself. We have shown how the forever filter can transform your decision-making, how a partnership with the force of compounding can create generational wealth, and how the alchemical inversion of volatility can turn fear into fortune. And finally, we have met the guardians of this new mind, the Zen of inaction, the egoless pursuit of the infinite game, and the unshakable foundation of the inner scorecard. This is the system. This is the mental model of the perpetual time horizon. It is not a set of tips or tricks. It is a complete and total transformation of your relationship with the most fundamental forces of investing: time, value, and human emotion. It is a path away from the frantic, anxiety-ridden world of the short-term speculator and toward the calm, rational, and immensely profitable world of the long-term business owner. It is a journey that requires discipline, courage, and a profound commitment to thinking for yourself. By mastering your own temporal perception, by installing your own internal clock, you gain the single greatest advantage available in the modern market. You are no longer playing the same game as everyone else. But mastering this internal dimension, this personal time horizon, is only the first half of the equation. Once you have this infinite runway of time stretching out before you, what do you fill it with? How do you ensure that the businesses you partner with for this multi-decade journey are themselves aligned with the great unstoppable forces of history? How do you pick the games that are structurally rigged for your victory over the long haul? Warren Buffett has a parallel mental operating system for this very question. It is a framework for identifying the massive, multi-decade demographic, technological, and capital forces that make long-term success almost inevitable. These are the great tailwinds of progress, the invisible currents that can carry a good business to greatness. Understanding how to see these forces, how to analyze them, and how to align your capital with them is the crucial next step in operationalizing the power of the perpetual time horizon. It's a powerful system he has used to make some of his largest and most successful bets. He calls it the tailwind protocol. To begin the complete deconstruction of that powerful framework, to understand how to harness the very currents of history to power your portfolio, click on the video that is now appearing on your screen.